Hey, welcome back. In this video, I want to talk about how to make sure you will never outlive your retirement savings. There's one big problem with retirement today, and that is too little or no directions on how to plan for your retirement. What's more, the common strategy is to put all your faith in one single asset, like only in the stock market or the real estate market. And as a result, we are unsure if we can retire comfortably and if the money we have will be enough for the whole retirement. And one question that I hear over and over again is, hey Thomas, how can I make sure I have enough money throughout my whole retirement? So today, I want to share my 4 piggy banks method with you. As you will see later in this video, these 4 piggy banks are the essence of retirement planning. It helps many retirees to gain confidence in their finance and sleep better at night. And before we go in, if this is your first time here, my name is Thomas, and this channel is to help Canadians to make better choices on retirement, wealth, and insurance. My goal is to make sure you can take 1 or 2 ideas home and start making better financial decisions today. So if you find this video valuable, make sure you click the subscribe button. Let's get started. The first and the most pressing piggy bank is the cash in your account. This is the money you use to pay bills, groceries, and other necessities. The key here is to have enough to cover expenses while also not holding too much cash in your account. And that's because the money will lose value due to inflation. So how can you create this balance? And I recommend it using your bank's checking and savings account to do this. Have about 3 to 6 months worth of expenses in there and keep the rest stashed away. This makes sure you're covered and can live your day-to-day life without money worries. The purpose of the second piggy bank account is to create a guaranteed income that will help you cover necessary expenses, your basic need. The point here is that the income must be guaranteed no matter the state of the market. If the market goes up and down, many forms of income aren't guaranteed anymore. But for your piggy bank number 2, you want your sources that keep their value. And here are some of my examples of what I mean guaranteed income. Government benefits such as the OA security or the Canada pension plan, they are great because once you're qualified, you get a guaranteed amount until the day that you pass away. Now, one could argue that the amount you get is a bit small. Yes, it's not going to be enough to retire just by relying on those government benefits, but it's still a good thing to have, simply because it's guaranteed no matter what. Another guaranteed income is, if you work for a big corporation or for the government, then you might get a defined benefit pension plan. In such a case, your retirement payout is guaranteed. Clients do ask me, hey Thomas, do rental income or dividends from stock holdings count as guaranteed income then? Some people might argue that rental income for any real estate you own is also a form of guaranteed income. But I will be careful. Rental income is always dependent on the rentees. If there's a tenant turnover that takes 6 months, that means there's no rental income for the next 6 months. So in my definition, it's not a guaranteed income. Anyway, what if you don't have a defined benefit pension plan, but instead you have the RRSP instead? Did you know that you can create your own pension plan for yourself? Annuity can be one of the options to consider. There are many forms of annuity, but the basic idea is that you pay a large sum of money to the bank or other financial carriers and they guarantee you a certain percentage payout until the term ends. Terms can range from 1-year terms to permanent, meaning it stays active until you die. Payouts is calculated depending on your gender, how much money you put in, your age and health, length of time, and interest rates. In a way, the annuity is act like a reverse insurance. Instead, you pay a monthly premium to the insurance carrier in exchange for a larger lump sum. Now you give the provider a large amount of money in exchange for monthly benefits. Annuity can also give you a slight tax advantage if you have it in a non-registered account, because the income payment consists of a return of principal and a part of interest, so it will not be 100% taxable. But there are also some downsides. 1. If the economy is in a low interest rate environment like right now, just like a saving account, the interest of your annuity will also be low. 2. 2. It's often the case that your money is locked away and you can't access it early. If you want the lump sum back early, you have to pay a hefty penalty. In many cases, an annuity pays the remainder of the money to the beneficiary when the owner of the annuity passes away, but this isn't always the case. There are scenarios where the annuity provider keeps the rest of the money if the owner passes away, so be aware of that. If you like the concept of annuity but you don't like the idea of being locked in, then there's another solution for you, and it's called the GMWB, Guaranteed Minimum Withdrawal Benefits. GMWB is usually provided by the insurance companies and it's like a combination of annuity and investment funds. And here's how it works. Let's say Tom is 65 years old and he wants guaranteed income to cover his needed expense for the rest of his life. So Tom decides to invest $100,000 in an investment with a GMWB option. Based on his age, the provider will guarantee Tom a certain percentage in the payouts. Let's say it's 4%. The provider will keep paying the 4%, which is $4,000 per year guaranteed until the day that he passes away. At the same time, the $100,000 will be invested in the market, usually in a set portfolio. The return depends on the market performance. Please note that the 4% guarantee payout is not a 4% return guaranteed, meaning if the investment return is 2% growth per year and the withdrawal rate is 4%, one day the saving will run out. However, in such case, the investment company will still have to pay the 4% from their own pocket to Tom until Tom passes away. There are 3 reasons why this plan is attractive. 1. The 4% payout is guaranteed, so no matter if Tom lives until 80 or 180 years old, the provider has to keep paying even the pie runs out. 2. Unlike annuity, the plan is flexible. Tom can cancel the plan at any time and take back the remaining of the investment based on the market value. And lastly, when Tom passes away, any remainder of the pie will be given out to the beneficiaries without the probate fees. As you can see, this is much more flexible than an annuity, and at the same time, it provides guaranteed income like a term deposit. What's more, this is an investment, meaning that you can put it in your RSP, tax-free saving, or as a non-registered account depending on your situation. There's only one downside I can think of. For most of the GMWB investment, the investment portfolio is set and usually they are heavy in fixed income. Think of a life payout saving account where you don't get to choose the investment, so an experienced investor could get a better return if they invest in something else. If you want to find out more and see if this option is right for you, feel free to contact me. Simply use the link in the description box under this video. Alright, so what's piggy bank number 3 about? As you probably noticed, piggy bank number 1 and piggy bank number 2 focus on your immediate needs and cash flow. This is necessary for retirement, but that alone isn't enough. Most people retire in their 60s, but the life expectancy of an average Canadian is mid-80s or even in their 90s. This gives us a unique challenge. Inflation will beat us in the long run if we leave everything in a saving account, so we do need to keep investing some of the retirement money. Where piggy bank number 2 covers your need, this piggy bank will help you to build your want, such as your own hobby or traveling, money that you can use for things that you enjoy. And how can you achieve this? This is back to the investing into the market with the help of tax-free saving, RSP, and other similar accounts. Plus, you can invest in a couple of assets that will help you diversify your investments. Last week, I made a video about the top 5 investments for retirement, and you can click the top corner to watch it. Overall, I recommend that no matter what investment you take, try to aim for an average of 4% return per year to beat inflation and to have a little bit of growth each year. What's more, the nearer you get to retirement, the more you want to go for cash flow accumulation over asset accumulation. So invest in things that can convert to cash fast. The reason for this is simple. If you don't have enough cash, owning a house won't help you much because you still need cash at the end of the day to pay for the bill. And that's why you want to secure piggy bank number 1 and 2 first, then go to investment after. The future income power created from piggy bank number 3 flows back to piggy bank number 1 and 2 a few years later. One of the most common retirement problems in Canada is people unexpectedly spend a lot of money on medical bills, mainly because they don't focus too much about this topic when they're young. While Canada has a good healthcare system, it only covers what happened inside the hospital. But what if you need long-term care, or you need to renovate your home to fit the future you? What about tools such as walkers or wheelchairs? We have to pay those expenses with our own money, and therefore, we need to prepare for it. But how exactly do we stash all the money for medical expenses? Should we simply put it in a savings account? The challenge is that we don't know when we need this money. It could be tomorrow or in the next 10 years, and therefore we need to protect the money from inflation. And that's why I recommend first get a home line of credit pre-approved. Yes, it means when you take it out, you have to pay interest, but because you have the credit approved already, you can then use the existing savings to invest and build. And when you do need to pay for your medical bills, you have time to convert your assets back to cash. Then my next suggestion is, if you're on an extra cash flow, then you can also consider insurance plans such as life insurance, sickness insurance to fund this piggy bank. You might still able to find long-term care insurance, but it's rare now as most of the players are out of the game. Also, there's another great advantage to life insurance. You can use it to fund your legacy account, so you don't have to worry about how much you want to leave to your next of kin. Let's be honest here. Do you remember who your grand-grandfather is? Most people don't even remember their grand-grandparents much, but not until they leave us a legacy, right? So my question to you is, do you want to be remembered? A legacy planning or estate planning might just be the way to go. Neither way, piggy bank number 4, make sure you have enough money for yourself, your children, or your grandchildren, and you can enjoy yourself during retirement. I understand the biggest fear we have for retirement is that the money will outlive us one day and we'll live our last days on earth in poverty. But to avoid all the headaches, it came up with the 4 piggy bank method. And while there's never a 100% guarantee, this method makes its way less likely that we have money worries during retirement. If this sounds like something you want but you're unsure where to start, make sure you use the link in the description box below to contact me. I'm more than happy to chat with you. This is Thomas, and I look forward to speak with you soon.